Canada, Stephen Poloz. To his right is Senior Deputy Governor of the Bank of Canada, Carolyn Wilson. There'll be a brief statement followed by questions. You'll get one each and then a follow-up to start. And please make sure your phones are on vibrate. Let's begin.
Well, good morning, bonjour. Senior Deputy Governor Wilkins and I are pleased to be with you today to talk about the June issue of the bank's Financial System Review, which we published just this morning. The FSR identifies financial system vulnerabilities and monitors how they evolve. It then looks at how those vulnerabilities could become risks to the financial system as a whole. Turning vulnerabilities into risks requires a trigger, an event that interacts with the vulnerability and has a magnified effect on the financial system and the economy. So we measure financial stability risk as a combination of the scale of the underlying vulnerability, the probability that a risk will be triggered, and the estimated magnitude of the fallout, if it is. Depuis la parution de la dernière RSF en décembre, le contexte macroéconomique mondial s'est d'abord détérioré, pour ensuite s'améliorer. La reprise de l'économie américaine s'est confirmée et les politiques monétaires expansionnistes ont aidé à stabiliser les conditions financières mondiales. Ici au Canada, les effets des bas prix du pétrole continuent de se faire sentir sur l'économie, même si les cours ont regagné une partie du terrain perdu. La reprise des exportations demeure inégale et ne s'est pas encore traduite par une hausse des dépenses d'investissement. Cependant, nous sommes toujours convaincus que ces forces sont en mouvement, étant donné l'expansion qui se poursuit aux États-Unis, les mesures de politique monétaire prises par le passé et les plans budgétaires annoncés. More recently, the devastating wildfires in Alberta pose a significant downside risk for near-term economic growth. But estimated insurance claims, while large, do not suggest a threat to financial stability. Today's FSR focuses on the same three vulnerabilities as our December report. First, the elevated level of Canadian household indebtedness. Second, imbalances in the Canadian housing market. And third, fragile fixed income market liquidity. We assess these vulnerabilities in the context of four risk scenarios, namely, first, a large increase in Canadian unemployment brought about by a severe recession. Second, a sharp jump in long-term interest rates driven by higher risk premiums globally and in Canada. Third, a sudden rise in stress from China or another major emerging economy. And fourth, a prolonged period of very low commodity prices. The first two vulnerabilities, household indebtedness and imbalances in the housing market, have both moved higher since our last report. However, in view of the improving economic outlook, there is now a lower probability that the risks stemming from these vulnerabilities will be triggered. This combination of higher vulnerabilities but lower probability leaves the financial stability risks related to those vulnerabilities roughly unchanged from our last report. Our view is still that a strengthening economy and rising incomes will reduce those vulnerabilities over time for the country as a whole. Nevertheless, it was the view of Governing Council that this conclusion merited a caveat, which is that the pace of house price increases in Toronto and especially in Vancouver is unlikely to be sustained given underlying fundamentals. This suggests that prospective home buyers and their lenders should not extrapolate recent real estate price performance into the future when contemplating a transaction. Indeed, the potential for a downturn in prices in these markets, although difficult to quantify, is growing. A significant decline in house prices could have material consequences for some individuals and for some entities in the mortgage business. However, the financial system as a whole is resilient enough to handle the potential impact. The third financial vulnerability featured in the FSR is the fragility of fixed income market liquidity. The empirical evidence on this is mixed, but there is considerable anecdotal evidence that fixed income markets have become less liquid in part as a consequence of regulatory reforms to safeguard the financial system. Now, we believe the system will eventually evolve in such a way as to make market liquidity more reliable over time. Nevertheless, we will continue to monitor and study this issue, both in Canada and with our international colleagues through the Financial Stability Board and the BIS. So all things considered, the Governing Council is of the view that financial stability risks overall have not changed materially since our last report. Let me also mention two very interesting reports also included in this FSR. Le premier brosse un portrait des caisses de retraite canadiennes, et en particulier des 8 principales caisses publiques. Le Canada est un chef de file mondial de la gestion des caisses de retraite. Et cet article fait un examen complet des activités de ces entités. Comme ces dernières jouent un rôle majeur dans le système financier canadien, il est normal que la Banque s'intéresse à leur travail. Je souhaite les remercier de leur coopération lors de la rédaction de cet article. The second report takes a look at the securities financing market in Canada and the implications of recent developments in that space for bond market liquidity. I do hope you'll take the time to read these two important reports. And with that, Carolyn and I will be happy to respond to your questions.
First question, Kim.
Hi, thank you for taking our questions. Kim McCrail from the Wall Street Journal. I'm curious if you could explain what prompted you to flag concern about Vancouver and Toronto in this report now, as opposed to in the last FSR in December or any other time?
Well, this is a continuous process where risks are evaluated, and those risks continue to build through time. It's not as though there's been some sudden change or anything like that, but all of those, the evidence continues to accumulate, and also the longer that these risks prevail, the bigger the impact can be if the risks are actually triggered. So the purpose of this exercise is one of risk assessment. It's not forecasting. It's a different exercise. So those risks are assessed on a continuous basis, and it's our perception that they are growing. And so we're also seeing evidence, particularly in Vancouver, but also in Toronto, where expectations of future price changes have become, to a degree, extrapolative. And we think that those expectations are probably not going to be realized. That is, that the rate of price increase in those markets has been outpacing fundamentals, and therefore would be unlikely to be sustained. And so we felt that the evidence was sufficient. The risks have grown to the point where we needed to be fairly clear that those things would not be sustained, and therefore they're mentioned in that way in this report.
Just to follow up, does the decision by the federal government to offer more in terms of fiscal stimulus give you any more room or more scope to be warning consumers about the possible risks in those markets?
I don't see a connection really between those two things, where this is an independent analysis of the risks as we see them. As we discussed in the report, the vulnerabilities in the housing and household sector have continued to move higher, and yet because of the improvement in the economic backdrop, the probability that there would be a trigger causing those things to manifest themselves is going down. And so it's that combination which suggests that the level of risk is about as it was before. Nevertheless, if the risk were triggered, the impact would be greater because those vulnerabilities have continued to grow. And so in the sense that the fiscal announcements that were made earlier this year are part of that improving macroeconomic backdrop, there is a connection in that way. But it doesn't change the analysis of the underlying vulnerability, in my view.
Greg Finn, Bloomberg.
Governor, in the past you've said you're the last line of defense. This seems like a pretty blunt warning to the public, but is this to be taken as a suggestion that the government needs to look even harder at what's going on in the housing market?
Well, we're part of a process in Ottawa. We're participants in SAC, the Special Advisory Committee, which is the channel that we use to offer our advice around these things. So I'm certainly not going to offer the government advice in a public domain like this.
You had mentioned a bias to lower interest rates earlier this year before the fiscal stimulus came in. If this is an amplified warning on the other side, does it kind of change the balance of risks around your monetary policy?
Well, as you know, we do our policy formulation in the context of a risk management framework, which has two layers, the primary mission being around inflation targeting, and there it's the risk balance is around the forecast, the outlook for inflation, therefore for the economy itself. Layered on top of that is the financial stability consideration, though that balance of risks. And so we've suggested in the past there may be situations in which the flexibility that we have around the inflation target gives us a degree of freedom to take into account large financial stability risks. But taking into account is a margin to maneuver which is fairly small. That is not sufficient for us to actually act, in a way which would be contrary to our primary mission in order to try to influence financial stability risks. It would be only in an extreme case where we felt that financial stability risks were so extreme that would put us off track for our inflation target for a long time. In other words, not within that flexibility window. So in that sense, then, the primary mission remains primary. That balance of risks continues as it was before.
Peter O'Neill, Vancouver Sun.
Governor, I think the first time an economist told me that the economic fundamentals didn't support the Vancouver housing market was about 1986. And if I had ignored his advice, I wouldn't be here today. I'd be doing a lot better in life. Are you concerned that there are dynamics outside of economic fundamentals, and in particular money coming from overseas, i.e. China, as a factor in the problem that you're addressing here today in Vancouver?
Well, there are multiple factors at work, that's for sure, and some we point to quite clearly in the report. The fundamentals, the actual fundamentals, which are levels of immigration, job creation, income generation in the Toronto and Vancouver markets, is well above the average for the Canadian economy as a whole. And there's a nice chart in there which demonstrates how there's a strong correlation between those fundamentals and the activity in the housing markets across the country. So those fundamentals, I think, are job one. Of course, what we're saying in the report is that the rate of price increase appears to be outpacing anything that we can point to as fundamentals. And the most important part of that mechanism that draws our concern or raises the risk rating is the extrapolative expectations part. If prices are going up because people expect prices to go up, then that, of course, is probably unsustainable, which is what we've described it in the report. And so those expectations will not be realized longer term. And so that raises significant risks, as we've discussed, in the household sector. Carolyn, would you like to elaborate?
Sure. You asked specifically about foreign investors, and as you know, the data on that is particularly poor, although some studies show that is a factor in terms of adding to demand. And so I think the question there is really the extent to which that foreign demand is sticky. And if there's an adverse shock, whether these foreign owners would actually sell, which would weigh into downward price dynamics. And nobody has an answer to that question yet, but governments are working very hard to improve the data there. I think what the governor is saying, though, is that the extrapolative expectations, whether it's foreign investors that hold those expectations or other home buyers or the lenders, it does create some vulnerabilities that we're worried about.
As a follow-up, your report didn't hesitate to cite anecdotal evidence in relation to the fixed income thing. The anecdotal story we're hearing in Vancouver is overwhelming about this influence of foreign buying, obviously affecting people's psychology. That people are coming in with cash and bidding, $3-4 million over, asking in some crazy instances. Can you specifically address this issue and say, do you think there should be a policy answer of some sort, even if you don't want to identify a policy for the government? Should the government move quicker? Because the government took office in October saying, yeah, this is a concern, and average price in Metro Vancouver has gone from 1.1 to 1.5 million. How long do you wait before you take action on this?
Well, again, it's the job of the FSR to identify risks and try to assess their magnitude. And as we've said, it's not, this has to be evidence-based, and it's very difficult to bring evidence on that when the data are so thin. You're right that there's considerable anecdotal evidence around it, as there are about other things, and those are inputs that we take seriously. But as far as recommending a pace of action or a type of action or any of that sort of thing, that again constitutes advice to the government, and we have formal channels for that, and I won't do them in public.
Richard?
Governor Richard Madden, CTV. Just to pick up on housing, you mentioned this in the past in the last FSR and other reports. In your estimation, how high is the risk of a housing bubble, particularly in Vancouver?
So we have no concrete measure of that risk, Richard. But what we know is what we're doing is, if you go back to December, it's a good reference because we of course had talked about it there. And so one of the things we said at that time was, well, one of the ingredients that really raises the risk profile is if you begin to see extrapolative expectations or self-reinforcing expectations. And so again, the evidence is primarily anecdotal, as just as mentioned. But when people say, well, I feel like I need to buy this, I need to buy a house because I'm worried that prices are going to go up this much again next year, and I'll be priced out of the market. Well, that means that they're making their decision based on an expectation of continued movement in prices of that magnitude. And we're concerned not just about buyers, but of course about lenders, because lenders are actually, this is what as we described, the first line of defense. It's where the actual decision gets made, is when you've asked, you want to buy a house and you're asking a lender for the financing for it. It's a joint decision. And so those expectations can play a role on both sides of that conversation. And so in our opinion, the fundamentals do not justify that kind of extrapolation. And therefore, we're suggesting that both borrowers and lenders take that into account, that they at least figure that into their calculus when they're deciding if this is the right thing.
And just to follow up, I know you cited it a few times in your report, but for people in Toronto and Vancouver who will be watching this tonight, when you say that these prices are unlikely to be sustained, what would you tell them to look for?
So what we said is that the rate of price increase is unlikely to be sustained. And we have to bear in mind that, as I said earlier, the fundamentals, the economic fundamentals in Toronto and in Vancouver are much stronger than they are for Canada as an average concept. And so this is exactly why we see such a divergence in the housing markets across the country. So that suggests that you should have a healthy housing market in both of those places. And so it's from that base that one asks, well, what are the risks that we identify? And are those risks, even if we can't quantify them very well, we can certainly see that they are growing. And so the risk would be, first of all, that the rate of price appreciation in Toronto or in Vancouver would be slower than it has been. So first of all, you should not extrapolate that it would continue. And what we said in the report is that you have to admit the possibility that the price could actually decline in these circumstances. But we're not predicting that or anything. We're just saying the risk that that could happen, whatever number it is growing as we sit here.
Talking about the housing prices, excuse me. Still, you mentioned it's unsustainable, these increases. That implies you have a forecast or an idea of how, when they will become unsustainable. What has to fill in to that time zone, to that time element that you're talking about?
So throughout, we've said that we believe that as Canada's fundamentals strengthen, as the recovery unfolds, that some of these vulnerabilities that we're identifying will lessen through time. So it's not just the vulnerabilities, but the potential for a trigger also lessens at the same time. So financial stability risks should drift down as we proceed forward. And that remains true for the aggregate, for the country as a whole. But in these two areas, we see a rate of price increase that would be very difficult to match up with any definition of fundamentals that you could point to, whether it's population growth, which is the most important driver. So we have both international and interprovincial net migration to those areas. So of course that's a prime driver for demand for housing. On top of which you have job creation and therefore income generation, which is growing faster than for the country as a whole. But beyond that, it's pretty hard to then say, well, how does that translate into, let's say, a 15% increase in housing prices, or in the case of Vancouver, say a 25 to 30% increase? There is no way to make that kind of connection. You don't need a formal model or a specific analysis of that in order to make that assertion. It has gone beyond fundamentals. But we don't have the tools to say how far or all that. This is exactly why we say it's a rising risk that one needs to take into account. And so I think that's probably as far as we can go with it. We can't really get more specific unless you want to add something.
Well, I think the right way to look at it, Gord, is just to see prices, say, for Vancouver have risen year over year, something like 30%. And it's hard to imagine continued growth in fundamentals that would support that. And so that is, one way to look at what underpins the statement that the governor was saying. That when you want to assess the risk, timing is a mug's game, as you know, when it comes to adjustments in prices. And so I think a useful way for us is what we did in one of our analysis, it's box 3, where we look at, well, what happens if prices decline by different amounts, 15% and 25%, were the simulations that we did. And then those are risk scenarios that you can look at and then make the assessment about what kind of financial system issues and economic issues would come about because of that. So that's how we prefer to look at it.
Go ahead. Yeah.
Touched on China and other emerging economies as a concern. What about bigger economies, like the UK with the Brexit vote coming up, the US with a possible Trump presidency? Are those major concerns as well as China?
Well, there's no question that the Brexit vote is coming up very fast, 2 weeks, I think, from today. And so it has already created quite a considerable amount of uncertainty. The effects of that uncertainty can already be seen in the UK economy, and so no doubt those uncertainties will continue until we have an outcome. And possibly after the vote, there will be a period of uncertainty. We don't know. So uncertainty is just something you don't really measure it. It just has this impact. Europe is already struggling as an economy. The UK was actually very nicely in full recovery mode and is moderating because of that uncertainty. So for us, it's more of a we have to wait and see and how the fallout may affect us. So for instance, as we allude in the report, one of the things you might see is a higher risk premium because of uncertainty in global bond markets. That wouldn't be unusual. As Canada, we We're just a small player in that space, and so our yield curve would capture or reflect some of that move up in the global yield curve. And that, of course, would affect mortgage rates here in Canada and other interest rates that people pay. And so there would be therefore some downside risk, either directly through trade or more indirectly through the financial markets. And it could also come in the form of equity prices and those kinds of things. So a lot of things to take into account. So that's Brexit. So I won't go into what risks may or may not come from the U.S. Certainly not going to talk politics here. The U.S. economy appears to be on a good, solid track, in my opinion. It's doing well, and we can see the effects of that in our underlying trade statistics. So all's well at that point.
Next question, beside Richard. Sorry, I don't know your name.
Anyway.
In terms of your comments on Toronto and Vancouver and your warnings to buyers and home builders, how constrained are you from sounding too severe for fear of being accused of starting an adverse shock?
Well, all I can say is that the evidence that we've been analyzing has been accumulating for some time. We've been gradual in both our analysis and in how we've discussed the matter. And again, we're trying to be very clear to people that we're not making specific predictions about any of those things, but trying to assess the risks and put them in front of people so that they can use that information. None of that, it can be translated directly into advice for an individual trying to make a decision, but what they can take from it is that if they're basing their decision importantly on an expectation that the recent rate of price increases will continue, our analysis suggests that that would not be a good assumption to base that decision on. That doesn't necessarily cause the decision to change. It causes to assess your own personal risks with that lens on it.
Follow up on the idea of the stickiness of foreign home buyers. You mentioned no one really has an answer to that yet, but it's trying to be measured. How would you measure that? Would that be something like the scenario-based case that you looked at in terms of negative equity in the FSR, something like that?
So the relevance for foreign borrowers would be, or foreign purchasers, would in the first instance be what would incite them to sell, because that would start a dynamic in terms of prices. Less demand means lower prices. I mean, one of the things that we do have anecdotal evidence on is that some or a proportion of foreign investors are paying cash, and so in terms of repercussions through the banking system, the Canadian banking system, those would likely be very small. And so really the channel would be, again, through the degree to which that resulted in a house price decline that would affect other borrowers' equity, which is exactly the analysis that we did in that box.
Andy Blatchford, CP. And then
Yes, Governor, thank you. Andy Blatchford, Canadian Press. I was wondering, you touched on it in the review a little bit about the changes that were brought on by the federal government in recent months. Do you have a sense of what kind of effect they may have had, and also what you're expecting perhaps from them going forward?
Well, certainly, over the years, there have been several changes, and of course, we have some changes in train this year, as you're alluding. The higher down payments, which were effective earlier this year. In addition, as of July 1st, there will be higher fees for government-sponsored mortgage securitizations. And then later this year, there'll be new capital requirements for mortgages for banks when those mortgages are given in hot markets. There's a test around the rate of price change. I think that's November 1st. Those are still being consulted on, so the exact form of that is not finalized yet. The issue with your question is that one can't really prove a counterfactual. We can't point to what the market would have been without those things. But we can say, I think, with a fair bit of certainty that that all that sequence of changes, starting several years ago, has succeeded in adding more buffering to the system. It has made our system more resilient to the sorts of shocks that we're talking about here. And so, we might look at a statistic on risk today and compare it to 5 years ago, let's say, and say, boy, that's almost as much risk, let's say, as we were looking at then. But the good news is the system is much more resilient today than it was 5 years ago. And so for the same kind of risks, we can have more confidence that it won't have a systemic implication, which is the subject of this report. It is not about the kinds of individual risks or the pockets of risk. What it's about is what sorts of issues could arise that could cause a problem for our financial system as a whole, what we call systemic shocks. And so, yes, we analyze the risk, but in the background, we know in our minds that the system itself has been getting stronger, both for things we have done, like you're talking about, but also, of course, the BIS reforms, the Basel III, and so on, that is to strengthen the entire global system, not just our own.
Just to follow up, I was wondering, in these markets like Toronto and Vancouver, where obviously many of the jobs are in the country, there's a lot of young people hoping to buy homes there. I mean, I don't know, would you say the situation right now is, despite that, unusual, and what do you say to young people who would like to one day buy homes here? What should they expect?
Well, again, I'm certainly not in a position to give individual advice like that. And every individual circumstances is different. But it is, just as for policy, there's a risk management question. For someone considering buying a home, there's a risk management question. What is the risk that the price of the house will be higher, if I wait? What's the risk that the price will fall if I buy? What's the risk that my expectation that prices will keep rising won't happen? All those risks kind of enter that. And as I said clearly before, it's not just about the buyer, but the lender who is contemplating underwriting this proposal. And so, but while it all varies from place to place and for individual, the one thing I think they can take from this is that those risks have gone up, and so they need to at least be acknowledging that and working through for their own situation what it would mean to them. So you might ask one person, they'd say, well, if I bought a house today, I'd buy it, and if the price went down, like as they analyze here, I'd be like, well, okay, that's unfortunate. I regret. Man, it'd be nice if I hadn't bought until after the price went down. But my intention is to live here, and as time goes by, that will all be forgotten, and I'll just continue to pay my mortgage, and so it doesn't necessarily cause a financial stability risk in that sense. However, of course, if you have to move, then your loss may be crystallized, and that puts the fact that you may be underwater in a much sharper relief. And so again, every circumstance is different. So I'm definitely not going to give any advice, but to take on board that those risks are continuing to rise. Do you want to add anything? No. Okay, good. Thanks.
Yeah, go ahead.
Gouverneur Poloz, deux questions pour vous permettre de pratiquer votre français. La première, depuis au moins l'affaire des tulipes en Hollande, il est toujours plus facile de décrire une bulle financière une fois qu'elle a éclaté qu'avant. Mais faisons un effort en ce qui concerne le Canada et son marché immobilier actuel. Dans votre revue, page 12, encadré 1, vous soulignez que la part des nouveaux prêts hypothécaires présentant un ratio élevé de prêts au revenu, c'est-à-dire plus de 450 %, a augmenté de 25 %. C'est-à-dire qu'on est passé de 12 % en 2014 à 15 % en 2015. La première question, est-ce que c'est alarmant? Et sinon, à quel pourcentage ça devient alarmant?
Bien, pour commencer, c'est pas alarmant. C'est quelque chose qui indique que les risques accrus. Et c'est juste un symptôme de la situation où les risques accrus. Et c'est pourquoi on analyse ces risques comme ça. Et il n'y a pas de point exact où ça devient quelque chose de plus important. Comme j'ai mentionné auparavant, c'est un processus graduel où les risques montent. Et je pense qu'à un certain point, l'évidence est suffisante de dire que ce risque doit concerner tout le monde. Et c'est tout. Tu as ajouté quelque chose?
Mais je pense qu'une partie de votre question était vraiment à quel point est-ce qu'on s'inquiète vraiment? Est-ce qu'il y a un plafond ou magique? Et puis, je pense que la réponse est magie noire. Et puis, mais la réponse est non. Le point qu'on veut vraiment souligner ici, c'est que le plus que les gens sont endettés par rapport à leurs revenus, le plus fragiles ou vulnérables ils sont quand il y a un choc à l'économie. Imaginons qu'il y a une récession et le taux de chômage augmente. Mais c'est plus difficile pour les gens qui sont très endettés, qui se retrouvent au chômage. Et c'est ça qui souligne notre point que la vulnérabilité des ménages endettés a augmenté.
La sous-question, gouverneur Poloz, concerne une partie de votre déclaration préliminaire ce matin. Bon, la Revue souligne une accentuation des vulnérabilités des ménages. Il y en a 3 vulnérabilités identifiées. Et vous dites que le conseil de direction estime que globalement, les risques pour la stabilité financière n'ont pas changé sensiblement depuis la publication de la dernière revue.
C'est ça.
N'ont pas changé sensiblement. Est-ce qu'ils ont changé? Et s'ils ont changé, est-ce qu'ils ont changé à la baisse? Et quel autre adverbe pourriez-vous utiliser que sensiblement pour qu'on comprenne bien ce qui est en train de se faire?
Mais franchement, c'est pas quelque chose de mécanique, monsieur. C'est évident que les vulnérabilités des ménages sont accentuées, mais on pense que la probabilité qu'un certain risque va les traduire en un choc important, cette probabilité a diminué. Alors, nous avons les deux choses en même temps. C'est-à-dire, c'est une question de jugement. Est-ce que c'est vraiment changé? C'est pas vraiment changé parce qu'il y a quelque chose qui monte, quelque chose qui diminue. Et, mais les deux choses sont pas mesurables, hein? Dans le sens très spécifique. Il n'y a pas de point décimaux ici. C'est juste c'est un jugement qu'il y a deux choses en même temps. Et grosso modo, le risque n'a pas vraiment changé.
Any more questions? Okay. Go ahead.
About exports and the Canadian dollar. You've hung your hat on exports for a long time, and even in the non-energy exports, they're not doing all that well. Is there I don't know, a number or a ratio that you give to, or the proportion to the effect of the Canadian dollar on either rising or lower exports when there are so many other considerations? If the economy in the United States is doing as well as you think it is, probably the federal funds rate will increase and the Canadian dollar will go down. And how much effect will that have?
So, well, that's several questions in one, isn't it?
I won't ask you something.
That'd be great. So, but I guess your question underlines the fact that it is a very complicated situation with a lot of things that are moving all at once. And I don't have a new forecast for you today. That would be a job for mid-July when we come back with the NPR. But the fact is that the export story that we've talked about is nicely intact. It's true that we had very rapid growth in exports over the course of the winter and into the early part of this year. And it was actually at the last NPR, we cautioned everybody to to not be overly optimistic about that, because some of that was catch up from a weak fourth quarter, and some of it looked transitory even in the first quarter. And those expectations have been realized. So we did get now a couple of months where things kind of toned down. But exports are at a much higher level, given that path, than they were, say, last summer. So the story is intact, and it's in the categories that we said would happen. And it's especially true in the categories that are exchange rate sensitive. And by the way, in the trade report, you don't get the services part. You only get the goods. The services part is quite important. So there's some big movements in things like tourism, which is very strong. So it shouldn't be forgotten. So all that to say that what we know is that the dollar moves around. It moves around because of expectations around policy, as you suggest, both U.S. policy and our policy. And it moves around because of the price of oil. In the last couple of weeks, we've gotten back up above $50, and that's kind of giving the Canadian dollar a little bit of upward move. So all those things are kind of working in the mix, and we have to put all those things back into our models over the next month or so and come back to you with a new bottom line and what it all means. And I won't do all that in my head right now. But I don't think you should lose faith in the underlying narrative, which is that the export recovery is matching what's going on in the United States. It's not even. It kind of goes, it's very uneven, actually, is what it is. It's volatile. But the underlying trend has been the right one. And so it's to a degree reassuring, but so far we have not seen the follow-through as companies, investing to follow up on that and expanding. And that's the next part of the sequence, which we'll be watching anxiously for. The CAPU data this morning kind of are an indication that, at least the progress is there, that companies are getting closer to their capacity limits.
Yali?
Yali, Market News International. I wanted to come back to China, and I wanted to know if their easing measures are maybe helping reducing the risks from China at all? Do you think that their easing measures are effective?
So if I understood correctly, you're asking whether the measures the Chinese government has taken is having an effect. And so what we're seeing in China is just a slowing to a more sustainable pace. And certainly that's expected because of demographics and other trends going on there. But it's risky and bumpy because of the big growth in credit that they've had, and some of the perhaps overinvestment in things like infrastructure. And so at the beginning of the year, you saw some bumpiness in Chinese data, and that's why the government there took some measures, both monetary and fiscal, to support demand. And I think we've seen some support coming from there. I mean, I think the question from a financial stability point of view is whether or not those measures, to the extent they encourage more credit and more investment, may not buy some growth today, but increase the risk of some disruption in growth further down the road.
And just one last thing. In fact, it's more clarification for me earlier when you touched the balance of risks. And did you say, taking into account everything that you've said and Toronto housing, it's still roughly balanced, the balance of risk to inflation?
Oh, I did. I don't think I talked about the balance of risk to inflation at all. So and I won't, because that's what we do in the MPR. But what we did say was that the Governing Council felt that the overall financial stability risks were roughly unchanged from 6 months ago. And in dipping into the details, we said, yes, some vulnerabilities, household ones, have gone up, but we believe that the probabilities have declined. So that gives you kind of a net effect, which is roughly unchanged. So it's not about the balance of risks around inflation. Okay? Okay.
Any further questions? Okay, thank you very much.
Thank you, everybody.
Thank you.